into the game. We're talking wood and grain. Charles bring the heat on Southern Yellow Pine. Mascot U.S. species, all is on the line. Gregg with the spruce, keeping knowledge defined. Ashen moderates, drop the facts in the booth. We on the buy, the sell ain't no hidden truths. Economics and trends, we got it all so clear. Lumber Word Podcast, best believe we're here. If you want to make more, get in on the score. Join us every week, you'll be hungry for more. Love a bit keen, though. Whoop made known. Such rain Charleston. Slide, plum, ram, known. Open to the scene. For the lumber supreme. Charles laying down facts with that southern yellow bling. Matt got that U.S. swagger like strong timber beams. Gregg's insights on spruce, rewrite the themes. Got the buy side talk, we stacking that flow. Selling knowledge, every week we still a show. Join the Lumber Word crew, let your business grow. For the sharpest minds, is what a place to go.
Hey everybody, welcome to this week's episode of the Lumber Word. And we have a reoccurring guest. Dustin, you're the reoccurring lumber industry expert economist. So we have Dustin Jalbert from Fastmarkets. Thanks for coming on. Dustin, got a lot to talk about today.
Yeah, I know. Thanks, Ash. It's good to see the gang again. It's been, but
look, go ahead. We got a little lag, so.
Oh, my bad. It's good to be back on with the gang again. A lot to talk about. Feel market's kind of shifting here in a lot of ways, so feels like we're getting back into some balance here. But yeah, we'll jump into that, I'm sure.
Sounds good. Do we have any more before we start? We were making fun of Matt's pink shirt before that, or Charles was. You don't have a whale on that shirt, do you, Matt? Because there's a store in Winnetka that sell nothing but those shirts in different colors with whales
Vineyard
on.
Vines.
Yeah, that's it. That's it.
It's a raven.
It's a raven.
Oh,
nice.
That's a private country club shirt, is what that is.
No, I got this in northern Idaho at the Circling Raven. It's actually a really good golf course if you ever get up to northern Idaho. So.
Well, let's jump.
Charles, is all the snow melted down there in South Carolina yet, or what?
Yeah, it's a muddy mess, and we'll probably get 3 inches of rain today.
Oh boy, that's not going to be good on the job site.
No, we talked to one in Charlotte, and they had crews shoveling 14 and a half inches of snow off the second floor that did not have a roof on it on Monday. Yeah.
Yeah, no, I loved it. All the yards were closed on on Monday, and some of them on Tuesday, and then like this morning they're going, "Hey, where's my truck?"
Yeah.
Yeah,
What's
Greg,
that tell you?
I just talked to a yard that has multiple locations in North Carolina. He said all their yards have been closed since Friday. They just started coming back today.
Yeah. And then they're going like, "Hey, where's my truck? Where's my truck?"
So let's.
I don't know if it's me, but we're just the trucking has really in like the East Coast with the back-to-back storms. Logistics has really backed up and is starting to be a real issue. I haven't heard like whether it's affecting rail shipments yet, but it's certainly affecting truck shipments. We're paying a lot more money to get the few trucks that we're getting. It's a little frustrating.
We're slow out here on rail cars. We're behind. Most of the Western mills are running about a week, 2 weeks behind on shipments.
Dustin, what have you heard?
Yeah, no, I think the trucking side, all the kind of industry reporting on that side of the market, especially I think flatbed and more broadly, it really has tightened up. I don't know so much that it's a demand story as just finally some capacity rationalization there. So I've kind of seen and heard the same thing on probably not so much on the rail side, but that would make sense that things are finally starting to tighten up here.
Yeah, no, it's interesting, Dustin, Gregg, Matt, Charles talking. Gregg and I were talking about this morning, and I was on the phone with a guy out in Oregon today, and he said, "Hey, I'm paying $500 more on hauls that were, $1,500 to $2,000 2 or 3 weeks ago." And as Dustin just talked about, I think it's a capacity thing. I think between immigration and just trucks have been so cheap, and trucking companies, certain ones went out of business over the last year. I mean, we've gotten more in line with capacity, and we'll see what happens there. So just to sum the market up, I was going to say I got 3 calls or 4 calls yesterday from people that are pretty, I would say, been in the industry a long time, all sounding scared on the market. Like, hey, if you guys are things slowing down, are you seeing more mills offering things? And I'm like, mills offer us things every day, right? I mean, the point is, like, what are you paying for them? And is there any fear, or are there just certain things? Perfect example, Matt, I got offered number 3 from a mill yesterday that never offers me number 3. And I think what that really is, they don't know exactly who to go to with it, because they just don't know who to go to with it. It has less to do with the market, or, somebody's offering out some 104 and 5 ace cars. I mean, fairly valued, getting to be an overvalued item. Maybe there is some stuff like that, but we're noticing we've got trucks backed up. Things still seem decent. I think people want it to go down, and hey, we're long but hedged, so it could go either way for us. And I don't have a fear that we're really going down. And we're definitely have a slower sales coming out of the gate. But again, we can't pile trucks on top of trucks we haven't shipped yet.
Mm-hmm.
Yeah, no, I mean, I started off before we came live, and like was saying how I hate sold futures today. $20 to $50 premium over today's cash price, and Matt, you were telling me I'm going to lose money on those. Is that what you said?
I said if you can make a quick $10, you should just take it.
Okay, quick 10. Take the quick 10. All right.
For the reasons that Ashley just talked about. I mean, can I expand on that a little bit?
Please
expand on it.
We've just had terrible weather in this country, and yet people are tracing our brains out on trucks, right? And you've got a 3-week order file on trucking, and our cars are late. I mean, it's not going to get any easier to buy lumber going into the heart of the building season. It might get easier for a little bit. Like right now, sure, we have a digestion phase. We might see the board go down to 575 or 580. That target's 578, where it flashed down to last week when there was no paper in there. But I mean, do I think I'll be buying spruce 2 and better at 530, 540 Chicago here anytime soon? Probably not. I just think that the deck is stacked against the buyer right now, logistically and economically. We're looking at, I can't imagine what the fourth quarter results are going to be reported as coming out of Canada.
Hey, Matt, quick question. Quick question for you.
Yeah, go ahead.
So I noticed Hem-Fir Coast is now on top of Western SPF to Chicago. Maybe it's trading higher. One of the big mills I heard was 572 Chicago for the first week of March shipment. Does that sound correct still?
I would say that all whitewood, whether it's Hem-Fir, WW, or spruce, any SPF South or ESLP that's coming out of the West is all kind of trading that 555 to 575 Chicago range.
That's a pretty wide range
for good randoms. Well, I mean, not everybody's going to pay the same price for an off species like SPF South or WW than they would for Hem-Fir or spruce, which have higher strength ratings. So there is a little bit of, differentiation, but the spread was $40 in favor of spruce back in November when you guys took delivery of Hem-Fir, right? Remember? And I told you that was abnormal. I said, hey, that's not normal. Normally Hem-Fir and spruce trade about equally. So we just got back to normal is all.
Yeah. So, and just to reiterate what we said last week, seems like Hem-Fir, Doug fir studs are up $100 in some cases. Is that from in the last month and a half, 2 months?
Yeah.
The only thing you need to deal with now is green. What the heck's up with green? That shit doesn't move at all. Or what that price?
It's, California is a little bit slow out of the gate compared to some other regions. And there's ample production to cover what people want. And so it's just boring. But, it has improved for sure. Green prices are up over the last 60 days. And And, I think that the long-term trend on green is probably going to be, positive also. I feel that way about just lumber in general and panels.
Gregg, spruce. I mean, we had one mill come to us offering us cars of random, that slight weaker telly. 565 Chicago today, Gregg. 560, 8 to 16.
565.
Bid him 530. Could care less if we had it at all. I mean, we got enough lumber right now, right? But it'd be interesting to see. But there's a few things showing up that people want to move. I'm not really looking at that as a weak market. What are you seeing on the buy side, Gregg? Since we haven't actively been out looking for anything from mills, what do you see from your mills?
I mean, there's general tightness. Yeah, I mean, there's, like you said, there's a few things that are popping up that people want to sell. I don't know that mills in the eastern mills in general are gonna rush to aggressively cut prices, but as things pop up, they're going to want to keep that lumber moving. I think that you probably have another week. If there's nothing significant happens in the next week or so, then I think that there'll be a little more pressure, and we could have a bit of an adjustment. We're in a secondary adjustment right now. The people that are have better logistics than we do, or that are closer to markets. One of the things is that, I mean, we supply up and down the East Coast out of northern border reloads, which are dependent on, to a large degree, on longer hauls than people with distribution in closer to the market, right? I mean, if you have distribution in North Carolina, in Georgia, in Tennessee, in Ohio, then you're going to be you're going to have a better local haul stuff is no issue at all, right? It's really the longer haul stuff. So, I mean, I think the thing that the two things that really struck my attention this week was the one that came across that showed that Euro shipments to the US in 2025 are basically flat with 2024. That was a real head scratcher to me, because that's not what we've been talking about, and that's not what our sense has been. I haven't seen the breakdown by country, and I suspect that what we'll end up seeing is that the decreases from Germany and Austria are going to maybe made up by increases from Sweden, but I don't know, maybe Dustin has something that he can share on that. And then the other was that we did know about and is like right in line with what we saw was where's my little numbers? Shipments from Canada, 2025 down 14.6% from 2024. January down 30% from last January. And the run rate in the Q4 going forward would indicate somewhere about a 23 to 25% decrease in lumber from Canada. I've been pinging, and maybe Dustin, you can chime in on this also, is whether we have what's the most latest updated U.S. South and U.S. West production to see where those numbers are and whether that's made up any of it. So those are kind of the things that kind of made me go, huh?
Yeah, I mean, I can jump in here, to talk to a few things here. One, to your point, Gregg, on the import side, the Euro imports and offshore imports, I agree. It was surprising how little those imports dropped year over year, right? So, I mean, you think about, this year we think, consumption in the U.S. probably, probably fell, 2, 3, maybe even 4% this year. So not really much change on the Euro side is surprising. I think some of that probably is impact from some front running of threats of tariffs and things like that earlier in the year. So, you probably had some shipments that came in early. Some of those tariffs, at least back in April, never materialized, right? So I think, there's kind of maybe some weird effects, but when you look in the second half of the year, offshore imports have dropped off a decent amount. So I think once that starts to carry through into next year, we will see that, and if you look at the year over years now on the monthly number, those have come off a decent amount. And then to your point,
I'm just saying, I contrast that with, we were at the Knowledge Traders Market in October, November when that was, and we're talking to people and they're saying, oh yeah, shipments are down 40%, but the numbers do not bear that out.
No, they agreed. They're not down 40%. They might be down 4 or 5%. I'd have to go look at the latest numbers to be honest. Sorry if I muted myself.
We have the number through November and it's flat with last year.
Yeah, so, right. Yeah, exactly. Agreed. Charles, go for it.
Charles, what do you got there?
I got a spruce question. So is that what's keeping pressure on spruce currently, is because the imports were a lot larger than we anticipated? I mean, what is the cause of that? Because everybody got fear mongered into, we're never going to see spruce again. It's going to be $900 because we have taxes and it costs $250 across the border and all the rest of this stuff, right? So I'm still trying to rationalize the downward pressure in spruce and kind of how it commingles with pine. And that information kind of tells me something different.
Yeah.
So,
well, certainly the Euro side's contributing to it. I also just think we had, to go back to Gregg's question on, the production picture, right? The U.S. production side is probably going to be flattish to up for 2025 when all is said and done. I think Southern Yellow Pine is trending around 2% up, and the West is around flattish on production, although shipments are definitely down more. So, which again, there's kind of an inventory building story that's contributing to this, right? There's definitely more inventory, I think, that's built up at the mill level out West. Maybe some of that has been cleaned up in the South, which is why we're getting SYP kind of on this rally we're on. But just to your point, Charles, I think it's just as simple as Canadian production. There was a lot of production last year, despite how weak demand conditions were, right? Especially in the first half of the year, kind of between the front running effects of the tariffs, there really were no mill curtailments, right? Mills actually were running pretty full. There was no temporary curtailments. Of course, there were indefinite and permanent curtailments from the prior year, from 2024, that were flowing through. But I think we just built a ton of inventory for spruce. Some of it came over to this side of the border, right? Front running the duties and later the Section 232 tariffs. I think something else that's maybe underappreciated, it's hard to track, but I was just looking through the data recently because we're kind of doing our big comprehensive update for our next sort of longer term forecast. And we look at some deeper data sets. On the Canadian side of the border, the domestic shipments of the Canadian production that didn't get exported, that stayed in their domestic market, that volume is up substantially in 2025. Consumption in Canada did not rise substantially. So I do wonder how much Canadian production is sitting on reloads on that side of the border, or just sitting in inventory that is, maybe it's not owned by the mill, maybe it's owned by someone else. I don't know that part of the business as well, but I think there's still inventory that's getting cleaned up out there. I think it's getting better, but I think that is probably weighing on the spruce side of the market. And there's just ample spare capacity that's out there still. There's just not been enough curtailed capacity yet, even with all the weakness of prices we've seen. So,
one question, Dustin. Dustin, you brought up a great point. From what I hear, living on this side of the border, the housing market in Toronto, in BC, everywhere is plummeting right now. The housing prices, the Canadian housing prices. So my guess is, they do things differently up there. Kip was explaining to me the other day, when you get a mortgage in Canada, it resets every 5 years, right? And you got to put like 25% down of the value of your house against that mortgage. So you buy $1 million house, 5 years ago, and the market drops 25% on it. You got to pony up a whole bunch of money to get your mortgage again. Would you have any indication of what the housing starts are over in Canada?
I think they're trending well. I would have to look at the exact numbers. I think they've been actually on the rebound here. I'll be, to be quite honest with you guys, we don't spend a ton of time on Canadian housing starts. And you know what the main reason is that there's just not that much wood
Not many.
consumed.
Yeah.
It's, if it's let's put it this way, so there's, Canadian housing starts are somewhere around, 250,000 units, might be even a little bit north of that right now. Obviously, the U.S. is much larger than that. We're around 1.3 million, right? So you're talking 4 to 5 times or 5 times more starts, right? Or 4 to 5 times, depending on the cycle and whatnot. But, the U.S. uses 7 to 8 times more wood per start, because it's basically flipped in Canada, where the vast majority of the production is multifamily, right? So this goes into the wood intensity per unit, right? So if most of these are condos, most of these are multifamily construction, they just don't move the needle that much on demand, and just bigger picture, Canadian consumption, right? Just for all softwood lumber, trends around 7 billion board feet a year. And again, that's just in comparison to the US, which is, I think our latest estimate for 2025 is around 49 billion board feet. So just the housing market in Canada just does not move the needle all that much. Now, there's a lot of talk about ramping up this big home construction program in Canada, to kind of stimulate the domestic economy with all the trade constraints and trade challenges. Like, maybe that helps a bit, but I just, to us, it's Canada's got to find that volume, get that volume back into the U.S. market for the math to work for them. So,
Hey, Dustin, I see that the U.S. Census is going to release November and December housing starts on February 18th. I think we're expecting that final 2025 numbers are going to be really flat with 2024. I guess, what do you guys expect, and what are your projections for housing starts in 2026?
Yeah, look, I think you talk about it 6 months ago. I think we were more optimistic, right? I think we were more optimistic, on the rates front, on the affordability front. I think it's probably going to be more of the same. Like, I think flat is a good description. I think housing starts, single family, kind of flattish this year seems pretty likely. That's obviously an improvement off of down, 8 to 10% where we're going to end up. I think once the final data is in, to your point, from the census, at least for single family. So that will be an incremental improvement, right? Like, we're not going down anymore. We're technically reaccelerating, but from a volume into play here, it seems unlikely that we're going to get a big reacceleration in single family starts this year. We're not expecting a big reacceleration in single family starts this year, just because even with all the kind of policy side of things, it looks like there's going to be an effort to try to stimulate building from the current administration. I think builders are going to be very conservative after the year they had last year. So we just don't see a big sort of burst of demand coming 2026.
The numbers that we had through October, where single family was down 7, multifamily was up 18. We've been getting the feeling since the start of this year that multifamily is continuing to be better. That was after a 40% drop in 2024 from 2023. Are you saying the same thing? You're thinking multifamily is going to continue to be stronger with single family being weaker?
Yeah, I think so. It probably is not going to be up whatever it is, 15, 20%. I forget what the final numbers are going to look like here, but it's up pretty strongly on starts. So, that's going to flatten out just because rent growth does seem to be challenged in most markets, right? And between that and some uncertainty in the labor market, right? I think that's, that will kind of keep things in check. But that said, even if 2026 is going to be a tough year for the economy, which I think is debatable, but the labor market seems to be challenged, right? I think that seems pretty clear. It's kind of this K-shaped recovery or whatever you want to call it. But, multifamily is not a story for 2026. It's a story for 2027, 2028, right? So I think if there's room for optimism, it's on the multifamily side where developers, a lot of them have capital to deploy in that space. It's kind of one of the least worst sort of opportunities in the broader real estate sort of market. So I think you'll probably see some some okay sort of growth in that market. We just don't think it's going to keep rebounding like the way it is right now. We kind of tend to trend around longer term, 350 to 400,000 units of multifamily we put into the market a year. And we're kind of back around that level now. So I think we'll probably, trend around that level here going forward.
The lumber market can be unpredictable, but with the right tools, you can make confident decisions. Fastmarkets is the trusted home of the Random Lengths weekly report, providing detailed pricing for over 1,600 products, including softwood lumber, structural panels, and more across North America. As for hardwood markets, the Hardwood Market Report is your go-to source for pricing benchmarks, market commentary, and in-depth monthly insights through HMR Executive. These resources give you clarity in a complex market, helping you stay informed and prepared. Fastmarkets Random Lengths price assessments are derived from verified price inputs collected via online submission forms, authenticated physical documentation, and interactions with buyers and sellers across the supply chain. All data is evaluated within Fastmarkets' proprietary assessment platform, Mind, in strict accordance with our published methodologies. Each assessment undergoes a rigorous approval process prior to publication. Key benchmark commodities are subject to independent third-party audits to ensure alignment with Fastmarkets methodologies and compliance with IOSCO principles for price reporting agencies. Get started with Fastmarkets today. Visit fastmarkets.com/lumbertalk to find out more.
Hey, Dustin, one interesting, I was on the phone with a large yards up in Connecticut the other day. He was telling me single family was a little bit down up there. Multifamily was okay, but he goes, the build to rent market was in fuego, basically. I'm like, what do you mean? He goes, we've got some projects with big home builders up here that we haven't seen, I think he said, since the 80s. And I don't even think he's that old, but maybe it's from basically boomers are selling their homes for $1 million that they bought for $3 in 1980 and destroyed the whole economy for the younger generation. And then they're buying these build to rent because they want a home to live in, but they're paying. They're paying. And he goes, this is projects that go for 2 or 3 years. And I'm like, have you heard anything like that in the Northeast?
I mean, there's definitely some pockets where there's clearly a lot of development happening. I couldn't comment specifically on whether they're built to rent or not. We don't have a lot of master plan communities up here, right? They're just there's just not the land available. There's a lot more sort of hurdles from a zoning perspective. That said, there are places that some of that stuff is clearly happening. I've got to think parts of Connecticut, certainly parts of southern New Hampshire, you're seeing decent amount of development, southern Maine, kind of the sort of lower cost of living places around some of the big, mega cities between New York City, Boston. So I think there's still development generally happening up here in the Northeast, right? But it's just, again, it's almost like the Canada story. It's just such a small base compared to the South and even parts of the Midwest or the West, right? That it's interesting. And you have these kind of micro, climates where actually things are doing pretty well. So I totally believe that there's some of these things happening. I think that makes sense. And that kind of boomers pivoting to retirement story is going to continue to be a thing that's playing out and a dynamic there that probably maybe still helps that build to rent story. Yeah. But I mean, I think there's pockets of like that up here, certainly. But it's again, I don't think it's necessarily moving the market though broadly from a wood products perspective.
So what do we think about like the Trump homes with the Trump homes? There where we see like we got
that was going to be my next question.
So
builders,
I saw a headline about this.
Push. The builders are gonna build the houses, and they're gonna rent them. People can come in and rent them for 3 years, and then those payments will basically be the down payment for the purchase of those homes.
But why don't so, like so?
Like my thing is that there's just like kind of all this stuff swirling. I mean, 3 weeks ago, it was like, hey, we're not going to let investors, buy homes for rent anymore. And then when it came out that like, well, the bottom line is that, big corporate investors, it's like, like it's a nominal amount of the market. And last year they were net sellers, and that, 90, 95 or 98% of all of the homes that are bought for rent are by like, individuals, et cetera, et cetera. So that was that got completely poo-pooed. And then they said, oh yeah, well, if you buy the whole community, then that doesn't count either. Right. So, but it sounds like the administration is
don't stop him. He's on a roll.
He's searching for something to help boost housing.
So here, so let me actually, this is a good point, and this is something we've been discussing internally as a team.
Do you hear that, Charles?
So there's the focus of the administration. This housing is clearly a huge priority for them heading into the midterms right now, right? Like they want to find a solution. So they've obviously thrown a lot of ideas out there. To your point, some of them have kind of fizzled out pretty quick. There's 401ks, drawing 401ks for a down payment. It sounds like Trump is against that. So I think one thing that's interesting is housing from a policy standpoint is going to be a key theme in the markets more broadly this year. Like we're going to keep hearing a lot about this. I think my thing, and I kind of alluded to this point earlier, I just don't think whatever gets passed is going to have any sort of traction to change the trajectory of what's going to happen this year, or what home builders are going to do, right, in terms of what their plans are, what they've already kind of budgeted out. But it's going to be like, maybe that changes the picture on 2027, right? But to go back to the original thing on this kind of Trump homes thing, I guess my question is, if this was kind of a great business model, why aren't builders already doing this right now, right? Which I think we probably know the answer is that it's probably not profitable, right? For most, and the amount of, I guess it's not delinquencies, but the number of actual people who reach their 3-year term and end up not being able to buy the home because it's still out of their reach of affordability. And then what's the builder do with that used home now, right? And all the maintenance and all this stuff that's on top of that. So I just think unless there's like a healthy subsidy program that comes from the federal government, and maybe that will be part of the plan, I have a lot of questions how that would be viable. But, who knows? Maybe they can figure it out.
Well, the one counter I'll give you to that statement, I mean, was it BlackRock or Blackstone? Who in 2008 just came in and cleaned everybody's clock and bought like $2 billion worth of single family houses between Phoenix
Blackstone,
and Miami?
Yeah, probably
Schwartzman,
Blackstone,
right? Yeah, Schwartzman's fund did that. So I mean, there's people out there
Invitation homes.
Yeah, that can take a used home and do what they need to monetize it, right? And I think it really boils down, as far as the efficacy and the expediency at which this can happen. Single-family home builders have inventory. There's a policy that's passed, and there's a special investment vehicle that is created for Wall Street to deploy more capital into. I think it can happen a whole hell of a lot faster than we think. I mean, it's just like some of these.
And with Wall Street deploys capital, will that make houses more or less affordable?
Well, it depends on how you, if it's a lease to own deal, right? That the builder has to make it equitable for Wall Street to take the inventory off their hands. So in 36 months, they can actually underwrite and sell based on the down payment over a 36-month period, right? So round number, $1,000 a month, $36,000, right? 10% down on a $360,000 house. Okay. In order for that to happen, right, you've got to reappraise it at time of sale. And then you've also got to make some money on your buy. And when you're moving $1 billion, 2.5 points is a lot of damn money. Mm-hmm. Right. So if you have the opportunity to do it, and it's a new investment vehicle or some derivative contract, we all know how creative they can be. There's a way to do it. And I think it could work. And the reason why I say that is because I'm going through a commercial real estate deal with my mother-in-law right now that rings true to it. It's not applicable to this, but in a small rural community, there's like and kind, I guess, operable decisions that would kind of correlate with what we're discussing, right? Because they have upfront cash flow. They write a check for it. They have a return on capital. And then they also have a return on capital when they go to sell it based on new appraisal and current market pricing. And then they'll somehow get in the insurance business to underwrite the homeowner's insurance. So they have a vested interest in all the prongs that go into it. As sad as it sounds, nobody wants to save any money and nobody wants to work. So the people that do, or the people that have the pockets, are going to be the ones that control it. I mean,
Charles, it may be easier just to let your mother-in-law move in with you instead of building a car wash and an apartment above it for her to live in.
Is she going to be managing the car wash also?
I don't think anybody wants that.
You're going to garnish her wages to make the down payment?
Yeah.
So
no, it's not. I'm not owner financing it for her.
I'm kidding.
We're just giving you a hard time. Good.
Yeah, exactly. We wouldn't tease you if we didn't like you. There's a couple things. I want to go back to your question, Charles, about spruce. What's keeping spruce down? Well, I mean, it's up for the year, right? And I don't think the euro is really anything to do with it. I think the Canadians themselves are tired of losing money, lots of money, and not real enamored with the United States government right now, right? I mean, you get that when you're talking to an average Canadian lumber guy. I don't blame them. And then, there's a couple things that have changed here in the last, say, year, maybe 6 months. There's now another wave of export business that's going to Asia or other places out of the West. I can't speak to the East because I don't do that. But our mills, we can ship some stuff to Asia now that we weren't shipping 3-4 years ago. That's back in play. So some of your low grade lumber and your kiln wets and some bad lengths, that's just now disappearing off a mill list. It's going into a vessel. And that's new. That's new business that we haven't seen for several years. And then I think that the Canadian intra-Canada trade has become bigger portion of, even though it's still a small overall portion of their mill net, it's more important now, and there's more of it. So the Canadian mills have options to keep that lumber that normally would have crossed the border away from me, and it's going to somebody in Vancouver or Calgary or Toronto. It's going somewhere intra-Canada at a slight discount. And then when you factor in the math of actual cost to ship it across the border, it's a significant discount, right, to what I would pay for it for just market pricing in the U.S. when you're paying a 35% tax plus another 10% tariff on top of that. So that's changed a little bit. I'm curious, equally curious from you, Charles, what's driving yellow pines change in direction here? And it seems to be sustained. It doesn't seem to be a one-off. Can you touch on that?
Which direction change are we talking about? Are we talking about the one that's still kind of lingering since November, or are we talking about? Okay.
The change from sub 300 to now in the low 500s delivered on a lot of key lengths of plate stock that people want to buy.
Hey, we ought to put this behind a paywall because you got to pay for this kind of information with random. Why are we any different?
Charles, that's what I like about you. You're all about making money.
He's like, show me the money.
Well, everybody's time is valuable on this call now. All right. So, really and truly, you kind of had a fearmonger scenario.
We're doing this altruistically, Charles. This is us. We're givers, Charles. We're givers. Come on.
I'll remember that next time you quote me, studs. Givers. I got your giver.
Touche.
Anyway, you kind of had a combination of spruce wasn't going to be around, so your tertiary, secondary markets are buying more pine, right? Which drove the price up initially, right? Everybody was fearful of $850 Canadian. Everybody anticipated euro imports to drop, but obviously the numbers say a different story, which I think in hindsight, that was an emotional decision on a market participant fault. But I think as far as pine goes, we're seeing a lot more sustained inquiry in pine in these secondary markets, which is forcing us to continue to buy more, right? We've been very disciplined. We've been selling Q1 jobs since September of last year, and we played it pretty well. We've been lucky, right? We had the right hedges. We had the right inventory volumes. We were able to continue to parlay that with open market buys, but we're in it every day, and we're buying every day, and we're selling every day. The big thing I think you're going to see is people that are afraid of the market, like what Ash described when we first started talking. And they say, well, what's going on? I'm afraid it's going to crack $100. I don't think the market in any species has $100 to give. I don't. And I'll die on that hill. $100 won't happen this time.
50?
And I think everybody's, I'd say
50 to give?
Yeah, I'd say 40 to 50. Yeah, that's probably a good round number.
I think the one thing, just to kind of, to your point, Charles, one thing that I think about a lot right now is, this has been a big move in Southern Yellow Pine. And, to Matt's point, looking at the FOB prices sub, well into the 200s per thousand, most mills in the South were not making any money, even against their variable costs of production. Now we're talking 400 to 500, high 500s FOB. We had a huge round of mill curtailments, or another pretty large round of mill curtailments in the second half of the year. A lot of them were Southern Yellow Pine assets, along with some temporary curtailments. I do think this is going to bring some of that curtailing production back online at these prices. But I don't know if it means we're going down 100, though. Don't get me wrong. But I do wonder, demand conditions are still not good, right? In the aggregate, in the bigger picture. So there is some species swapping that's happening. I agree. There's some market share gains for U.S. producers that are going to continue to happen this, in 2026, 2027, including for pine. So you have to factor that all in. I do wonder if we give some of it back, though, once we get a supply response here that I think is kind of, it's going to take a month or two to see, but I think that is coming.
What's interesting is every mill, I don't care if you're in Canada, probably the Pacific Northwest, every mill, many of them are out looking for money right now, right? Because I don't think you're making money at these levels in the South. I don't think you're making money in the Pacific Northwest. And if you got and check my numbers on this when I sent over, like if the median cost in Canada is $425, $105, which is 25% AD, and as like Kip told me, you don't put these taxes on top of taxes. So $43 with a 10% DVD, 10% with Section 232, $112 freight Chicago. You're $728 Chicago break even on most Canadian mills right now. And where are we at right now? 500 and something, 72.
570,
so,
575.
and customers keep
and 728 is a mill net for everything, Ash. So you got to actually reduce that 572 for number 3 and low grade.
Yeah, so think about it. So if I think customers are telling me that Canadians are going to even make more production, and there's going to be more production come on. I saw that big Southern Pine Mill write down goodwill on mills. Mills don't do that if they want to open up production. They do it because they want to shed some production. And talking to some people yesterday, I truly believe that most big customers, chain yards, everybody have their lowest inventory in 3 years and their lowest inventory at their yards. And that's why people are calling for trucks the next day that they never did that. And so my problem I'm having is if we are losing money at this rate, how can customers base their buying decisions long-term on thinking that people will produce more? I mean, maybe they will. And I know I saw where a big Canadian miller got $30 million from the Canadian government a couple of weeks ago. I mean, these guys are running on fumes right now. They'll burn through $30 million to keep running. So, like, I don't think you're going to see you're not going to see a lot of stuff come back on. I mean, wouldn't it be something if the next mill curtailment we saw was in the United States, in the U.S. instead of Canada?
Dustin, I looked at you put out a really interesting chart on LinkedIn. You want to talk a little bit about that? I mean, like it kind of blows me away. I mean, and I don't know what date that was up to, obviously, but it basically shows that inflation adjusted lumber prices are at like their 2008, 2009 low, which was, I mean, we lost 40 over the next few years. We lost 40% of capacity from that point on.
Yeah, I mean, I think It's a good point, Greg, because I mean, I don't think we're at that point when we look at, the actual demand supply balance, right? But it's when you think about lumber in relative terms to the broader pricing trends across the economy, lumber has just not kept track with the broader inflationary trends we've seen, right? So in that chart, all it just shows, it's very simple. It just looks at the random lengths framing lumber composite price divided by the producer price index for all wholesale commodities, right? So it's kind of intermediate commodities that it's referenced against. What I like about it is, like, if you just want like one simple metric to understand how strong or how weak the market is, that's like kind of, if you want to like a quick toolkit, like, play armchair economist or whatever, that's a great way to compare any commodity. And usually what happens is most commodities have like an upward up and to the right moves on prices just because of cost inflation pushes everything up over time, labor, energy, all these things, right? So when you control for that, you get more of kind of a sideways picture on a lot of commodities like lumber. And you can kind of see in the weak periods where you're low, you're kind of low in inflation adjusted terms, those tend to be periods of secularly weak demand or supply factors if they drive prices up or down, right? So you kind of can see the big sort of existential shifts in the market. And that's why I like that chart, right? It kind of shows we have a huge dip in prices during the GFC. We obviously went to the moon during COVID. You go back to the spotted owl crisis. That was a very high price period in real dollar terms. But yeah, today, like, lumber has just not kept up with the broader inflation picture. And that, I think, when you think about it, like why everyone feels like this is, even though demand is not GFC level down, global financial crisis bad, when you look at it in inflation adjusted terms, it is back to GFC levels or kind of flirting with that area, right? So that's what I mean is, when we think about where we are, the demand situation in the market, we are still a long ways to a point where mills have really substantial pricing power where they can price above inflation, right? Like that's kind of the key take home. We've got a long way to go to get back to those points. So I just, to bring it home with Ashley's point, like there's going to be a lot of mill curtailments, like I think in Canada this year, they're going to have to be, but it's going to take a lot to move the market. And, oh, by the way, we need demand to start moving in the right direction. And we're just not sure that that's going to happen this year. I think it's probably more the same. So
how do we transition what you just said to really the root that's going to move the needle is affordability, right? I mean,
yeah.
So we've got a whole generation, maybe 2 generations of people that are forced renters or, still living at home with mom and dad, or, they're not homeowners. And from the country's perspective, if you're an economist, you want households, you want wealth formation through household ownership, right?
Yeah.
That you go out and buy a new washer and dryer, and you buy a couch, and you buy a TV, and you become a homeowner. So it changes your future earnings potential, and it's just wealth formation for the country. So I see what Charles was talking about earlier, like this rent to own type idea, how that would be appealing to a lot of 24-year-olds, like that have a college degree. They might not be making $150,000 a year, but they're making enough money to afford $1,000 or $1,500 a month. And
yeah,
I would love to see more creative ideas from the consumption side. So, we can make policy, we can make laws and policy in Washington, D.C. or at the state level, county level. We can try to work on the cost of permitting and some of these barriers to entry to home builders at the local level. That's another way to look at it. We can target the $300,000 to $400,000 homes, like new home construction. And, you go drive through an older neighborhood in your town. Everybody's got this in their towns that was built in the 70s and 80s. And a lot of those homes are small. They're like 1,000 to 2,000 square feet, because that's what they could build when interest rates were 15% or 12%. They had to build something smaller. Well, we need to be doing similar things and thought processes We don't need to be building a bunch of 4,000 square foot $1 million homes. That market is small. And so that's what I think.
Are you still relying on snail mail publications from the 70s to reach the forest products industry? It's time to upgrade. Advertise in the Lumber Word podcast and get in front of the lumber world every single week. Our episodes are tuned in by the largest segment of influencers inside and adjacent to the forest product sector. Decision makers who shape the industry. Ditch those tens of thousands spent on outdated print ads and project your product or service across the podcast universe instead. Ready to make the switch? Head to thelumberchannel.com, click on Connect, and drop us a line with your info. Let's amplify your message today.
The only thing
hopefully we go that
I'll
direction.
say to that, Matt, is, by the way, my wife loves that show, Tiny Houses. You know, I mean, it's crazy. But you know, there's a three-legged stool to housing affordability. One is people make more money, higher incomes.
Yeah.
The other is the cost to borrow the money, lower mortgage rates. And the third is lower prices. To that point, I think I sent you guys an article yesterday that showed that last year we've moved from a seller's to a buyer's market in the existing home market. The highest percentage of price cuts in existing homes since 2019 last year. Average discount was 62% were at prices below asking at an average of 8% below that. And that's heavily skewed and bigger discounts in the high beta markets, Florida, Georgia, Texas, the places where we had the most building and the most price increase. You know, the other side is the market that's doing great is the super high end. Like sales of homes over $10 million are strong as can be, right? You know,
I wouldn't know.
That's kind of crazy.
So the guys that are creating this build to rent portfolio are buying those?
No, that'll slow down after another week of Bitcoin selling off.
Yeah, well, I do want to address, you know, I saw yesterday, you know, everybody's been AI this, AI that, and yesterday Anthropic came out with basically a tool that disintermediates a whole bunch of software companies, you know, AI add-ons. They give it away for free. It basically now, you know, you need to review legal documents, got it. You need to review permitting plans, got it. You need to, like, I mean, it's absolutely crazy how powerful it is. I was really unhappy. You know, my Palantir, which was up after having great earnings, is down 10% today. They're hating it over there. But anyhow, that was an aside.
Hold on. Speaking of downside risk, Ash, did you ever trade out of that silver position?
I did. I dipped my toes back in the water in the last few days though. And so I had to give some of it back, but not very much. Like I caught that one like better than I've ever caught anything.
I was close.
And so it's one of those things where you make money and you really don't know what you actually just did. And you're like, well, that was fun.
It sounds like Enron.
It was, yeah. Yeah, it was, but I mean, I guess my feeling is with all of this, mills still aren't making very much money, but demand is okay. I think we're still, so I guess, Dustin, you think demand and supply are pretty close right now, where we've got that one less stick being made, or how do you feel, or is the price escalation over the last few months more to where is the wood in the pipeline right now?
Yeah, I mean, I guess the way I think of it, guys, and you know, jump in if you think I'm wrong, but I think last year a lot of the oscillation in prices was kind of policy uncertainty, like kind of front running tariffs, back end. Yeah. So like I think when I think of second half of last year, that was this inventory overhang with all this wood that came across the border, this overproduction, right? So we overswung on spruce. It clearly, I think, at least partially fed into SYP. You know, we had too much production. You know, so I felt, you know, when we model it out, we've been missing to the high side on our price forecast for the second half of the year, just because we felt like, I mean, demand is not great, and it clearly did shift down a gear when we look at housing starts, especially single family entering the late third, fourth into the fourth quarter here, and we'll get some more visibility on that. But demand the fundamentals didn't seem to justify prices that bad. I kind of feel like this inventory situation is getting cleaned up a quarter or two ago. So, but I think we're coming back towards fundamentals. I think we're getting close to fundamentals here. So
I think going back to what Gregg said about the 3 legs to the stool, 2 of those things seem to be working in the right direction, right? It's the affordability thing, but yeah, I do think people are making more money. And I do think that the loaning costs have gone down a little bit. Now, if we can get the affordability side of it kind of in the target zone, you could have a pretty good year, right? I mean, why do you think multifamily's been resurgent here the last couple of years? That it's affordable. It's what people can do. So,
boys, go ahead, Gregg.
No. I was going to say, Dustin, I don't know do you know where you guys are in terms of, final U.S. production numbers at Fastmarkets in terms of getting that information out to the marketplace?
Well, the industry data still comes through from Stats and WWPA. Like I said, North American production is actually trending kind of flat to slightly down. I think it's probably going to end closer to like down 1% for total North America in 2025, which is not a big drop considering where the market has been. But I emphasize that I think demand was probably off by more than that. It's probably closer to somewhere between 2 and 4% that demand is off, right? So that kind of emphasizes the disconnect where production is kind of lagging behind the drop in consumption that we saw last year. So,
got it. Awesome. Always good to have you, Dustin. I mean, you're a real trooper to put up with our BS.
Yeah, right.
No. Hey, sorry about the connection issues. I'm not sure what's going on my end, so apologies about that. But always great to connect with you guys, and I'm always willing to jump into the banter here. So thanks for having me again.
I think it's all that snow you got.
Yeah, that's it. He's under
snow.
I mean, Charles, let's go behind the paywall and really get jiggy with it, huh? What do you say?
I'm waiting on you, Gregg. Let's do it. I'll bust out the whiteboard and everything. Look, I'm just waiting.
Oh, nice.
I'm waiting on Ash to give us the actual green light.
All right.
Cheers,
I'll work on it. All right, guys.
It was great. Thank you. See you, Dustin.
Guys.
Y'all
Bye.
be good.
Thanks for listening to this week's episode of The Lumber Word. The Lumber Word podcast is dedicated to engaging conversations about the lumber industry, including trading ideas, market trends, and evaluations of overvalued and undervalued assets. We wish to emphasize that the discussions and opinions expressed in this podcast are purely for informational and entertainment purposes. They should not be considered as financial or investment advice. We encourage our listeners to make their own financial decisions, taking into account their unique circumstances and financial goals, and to seek professional financial advice if necessary.